Hello everyone, welcome back. In the previous episode, we established one core judgment. AI is not over, but the AI sector has already started to split internally. This week, the US Treasury market is waking up, and rising long-term yields will pressure the valuation ceiling for high-valuation technology stocks. The current market faces two layers of pressure. The first layer is AI return validation. Microsoft's rare 3-day surge in 26 years with a cumulative gain of 24.9% proves that the market is willing to reward companies that can truly turn AI investment into revenue and profit. Azure growth, more than 30 million paid Copilot seats, and $19.6 billion in free cash flow are the core reasons the market repriced Microsoft. The second layer is confirmation of capital rotation. Continuing to rise on strong volume after good news is real strength. Failing to rise or even falling after good news is a risk signal. The market is now constantly screening among AI, financials, and cash flow assets. Only names confirmed by both price and volume are worth following. Based on this framework, we have selected 4 latest targets: MSFT, AMZN, JPM, and ICE. We will break them down one by one, combine candlestick structures with fundamental validation, and provide follow-up trend judgments and trading suggestions. These 4 stocks represent 4 directions: AI return validation, cloud infrastructure, core financial platforms, and financial market infrastructure. First, MSFT. The strongest validation from the previous video has now been upgraded into a core watchlist target. Microsoft closed at $487 on August 3rd, with a cumulative 3-day gain of 24.9%, marking its strongest 3-day performance since October 2000. From the candlestick chart, the stock price has moved far above the 3 moving averages, and the short-term moving averages show a textbook bullish divergence. The current price still has about 13% room to the recent high of $551. The J-value of KDJ has already reached 98.54, an extremely overbought area, which means the risk of chasing in the short term is very high, but the medium-term trend has been confirmed as bullish. Trading suggestions. For existing holders, use $450 to $455 near the original earnings gap and MA10 as the trend defense line. Continue holding the trend position and do not exit the entire position easily just because the stock has risen a lot in the short term. Before the strong structure is broken, let profits run. For those not yet in the stock, absolutely do not chase at $487. A more reasonable strategy is to wait for a pullback toward $465 to $470 and observe whether there is a low volume stabilization signal. If the market gives a deeper pullback, $450 to $455 is a better core accumulation zone. This area has been upgraded from ordinary support into the dividing line between trend strength and weakness. If Microsoft breaks below $450 and cannot quickly reclaim it, we need to be alert to the risk of good news being fully priced in. At that point, we should reassess whether the AI return logic has already been fully priced. Next is AMZN, the second positive sample for AI cloud, now waiting for capital rotation to continue. Amazon's candlestick chart shows a bullish alignment of short-term moving averages. The recent high of $287.20 is short-term resistance, while the MA5 around $256 below forms the first support. In terms of technical indicators, the KDJ values are K at 66.42, D at 50.35, and J at 98.54. The J value has also entered an extremely overbought area. Similar to Microsoft, there is short-term pullback pressure, but the medium-term trend has already turned bullish. Fundamental validation. Amazon has not yet released its latest earnings report, but the market expects AWS cloud growth to validate the return logic of AI capital expenditure. If AWS growth exceeds expectations and free cash flow improves, Amazon may become the second AI return validation sample after Microsoft. AMZN is currently suitable for light position observation and is not suitable for a heavy bet. First observation zone, $270 to $275. If it pulls back and stabilizes on lower volume, this can be used as a tentative accumulation area. Core accumulation zone, $255 to $260. If the market gives a deeper pullback and the fundamentals have not deteriorated, this is a better medium-term entry point. Upside confirmation. If it breaks above the $287 to $290 area on strong volume, it means the market is officially recognizing the AWS growth logic, and a right-side add-on position can be considered. Stop-loss discipline. If it breaks below $248 on heavy volume, below MA10, the cloud business growth needs to be reassessed for whether it is below expectations. Now let's look at JPM, a core financial asset and a broad beneficiary of high interest rates and high volatility. JPM stock price has risen a cumulative 166.6% from the low of $123, and the long-term uptrend is extremely strong. The stock is firmly above all moving averages. The recent high of $359 forms short-term resistance, while $347 below is the first support and $335 is the core support. Although JPM's gain has been huge, its trend remains very stable, and its volatility is far lower than technology stocks. It is a typical high-quality core financial asset. Fundamental validation. Second quarter net income was $21.2 billion, with EPS of $7.70. Investment banking fees increased 30%, and markets revenue increased 35%. The more complex and volatile the market becomes, the more a super financial platform like JPM benefits. This is highly consistent with the macro backdrop of elevated volatility in the US Treasury market. JPM is suitable as a core anchor within the financial sector, but it is also not suitable for chasing at high levels. First observation zone, $347 to $350. If it pulls back and stabilizes on lower volume, an entry can be considered. Core accumulation zone, $335 to $340. This is an entry point with a better risk-reward profile. Breakout confirmation. If it holds above $360 on strong volume and effectively breaks the previous high of $359.30, upside room opens up, and the next area to watch is $370 to $380. Stop loss line. If it breaks below $330 on heavy volume, the capital flow in the financial sector needs to be reassessed for a possible reversal. Finally, ICE. It is a direct beneficiary of US Treasury volatility. ICE's candlestick structure is relatively weak. The short-term moving averages are in a bearish alignment. The recent high of $187 has formed clear resistance, while the 52-week low around $99.59 forms long-term support. ICE is currently in a pullback and consolidation phase and has not yet confirmed a trend reversal. Trading volume was 20.15 million shares and turnover was 3.57%, showing that selling pressure is not extreme, but buyers have not yet become active. ICE is the parent company of the New York Stock Exchange and recently announced a $5.7 billion acquisition of market access to strengthen its fixed income electronic trading platform. Fixed income and data services revenue grew 8%. If the US Treasury market enters a high volatility phase in the future, demand for bond trading, clearing, data, and risk management will directly increase ICE's business volume. ICE is in the stage where the logic has been validated, but the technical setup has not yet been confirmed, so patience is required. First observation zone, around $150. Watch whether it can stabilize on lower volume. If it holds above $150 for several consecutive days, a light position test can be considered. Confirmation add-on zone. If it moves above $156 to $160 on strong volume, it means capital is starting to reprice the fixed income trading logic, and a right side follow-up position can be considered. Core accumulation zone. If it pulls back to $145 to $148 and the fundamentals remain unchanged, this is a better medium-term entry point. Stop loss line. If it breaks below $145 on heavy volume, it means the acquisition logic and the US Treasury volatility beneficiary logic are not yet accepted by the market, so the position should be paused and reassessed. Continuing to rise on strong volume after good news is real strength. Failing to rise or even falling after good news is a risk signal. At this stage, reducing trading frequency is a way to protect capital and energy. This stage is more suitable for building a watch list, waiting for industry capital flows to strengthen further, waiting for individual stocks to break through key resistance, and waiting for volume to confirm the move.